Howdy, Ken Pederson coming at you. And yeah, the Fed bumped rates again yesterday. Check out my Fairway fidget spinner. So the Fed bumped rates yesterday. And what's this mean to mortgage rates? Number one, the Fed does not control mortgage rates per se. They control the federal funds rate, which is how banks lend money to banks. Almost the Federal Reserve lends money to banks almost on an overnight, like 1 to 2 day window. So it's a very short-term interest rate. When the Fed bumps rates, they're not talking mortgage rates, they're talking about the federal funds rate that the Federal Reserve lends to banks overnight. Very short-term money. What the banks do in turn, because their cost of borrowing goes up, they raise their prime rate. So prime, for every bank across America yesterday and this morning, raised the federal prime rate from 4 to 4.25%. 99% of all home equity lines of credits, HELOCs, are tied to prime. So most consumers that have a line of credit secured against their house, that rate went up 0.25% yesterday. Long-term mortgage rates actually got better later in the day. So the Federal Reserve move, which was expected because they told us about it before, had little to no impact on mortgage rates. The Fed does their best to act transparently, so the market had absorbed the impact of the Federal Reserve move already because we knew about it. The Fed's also telling us there's going to be another Fed bump later in the year. So the market's already absorbing that information for us. A couple interesting things though. Number one, mortgage rates did improve better. Mortgage rates are back to the point where we were like just post-election, really, really low rates. It's crazy. Again, that's number one. But number two, the economy's chugging along, but retail sales were actually reported down in May. And the core inflation rate, which is one of the key numbers the Fed looks at, is under 2. And the core inflation rate, their target is 2%. So if that core inflation rate stays low, we may not see another Fed bump later this year. We'll see. We'll got to wait and see. The other big impact that will have an impact on mortgage rates is the Fed has been the largest buyer of mortgage-backed securities. Mortgages get wrapped up into bonds. Fed's been buying the mortgage-backed securities, the largest purchaser of mortgage-backed securities since the crash, since the recession. The Fed is telling us they want to stop purchasing those mortgage-backed securities and bonds later this year. So if they stop buying, that could impact mortgage rates. But today, yeah, for today's buyers, not a concern. Mortgage rates are crazy low. Mortgage rates aren't going up today. They're not going up tomorrow. Unless something crazy happens out there in the world, the economy is moving along, not too fast, where mortgage rates are going to raise naturally. So there's the news. Sorry it took a little bit, but it takes a little bit to explain what the Fed does when they bump rates and how it's really not impacting mortgage rates. And in essence, it's almost helping mortgage rates to stay low. You have a great day. You have more questions, give me a shout. If you want your own Fairway fidget spinner, give me a call or shoot me an email and I'll drop one off for you. You have a great day.